The Kremlin wants the world to believe in a strong Russian economy. They project an image of stability and growth, showcasing the nation's resilience and strength. This narrative is carefully crafted to maintain confidence both domestically and internationally. State media boasts of stable GDP growth, often highlighting selective data that paints a rosy picture. They emphasize the positive aspects, such as certain sectors showing improvement, while downplaying or ignoring the negative indicators. They point to economic resilience in the face of Western sanctions, suggesting that Russia has managed to weather the storm and even thrive under pressure. This narrative is designed to instill a sense of pride and confidence among the Russian populace. However, this narrative is crumbling. Beneath the surface, the reality is starkly different. The infrastructure is deteriorating, and the economic indicators that are not highlighted by state media tell a story of decline and struggle. Independent analyses tell a different story. Experts outside the influence of the Kremlin have been raising alarms about the true state of the economy. Their reports reveal significant weaknesses and vulnerabilities that are often glossed over by official sources. Data on international trade suggests a far weaker economy. The numbers show a decline in exports and imports, indicating that Russia's economic interactions with the world are not as robust as the Kremlin would like people to believe. The truth is that Russia faces a looming economic crisis. The signs are everywhere, from the declining value of the ruble to the increasing number of closed businesses and empty retail spaces. The banking system is on the brink. Customers are increasingly worried about the security of their savings, leading to a rise in withdrawals and a lack of confidence in the financial institutions. Years of mismanagement and the war in Ukraine are taking their toll. The conflict has drained resources and diverted attention from critical economic issues, exacerbating the already fragile situation. The official narrative is a facade. It is a carefully constructed image that hides the underlying problems. The cracks in this facade are becoming more apparent as the economic pressures mount. It masks the true cost of the war. The financial burden of the conflict is immense, and the impact on the economy is severe. The resources spent on the war effort could have been used to address domestic economic issues. The Kremlin has gone to great lengths to conceal this cost. They have implemented strict controls on information and have tried to suppress any dissenting voices that might reveal the true state of affairs. But the strain on the system is becoming impossible to ignore. Inflation is rising and the cost of living is becoming unbearable for many Russians. Protests and public dissatisfaction are on the rise. The banking sector in particular is showing signs of deep distress. Employees are under immense pressure and the stability of the financial system is in jeopardy. The situation is precarious and the consequences of inaction could be catastrophic. Without significant reforms and a shift in policy, the Russian economy is at risk of a severe downturn that could have far-reaching implications. The war in Ukraine is bleeding Russia's economy dry. The conflict has not only led to a significant loss of life and property, but has also placed an enormous financial burden on the nation. The direct costs of military operations are staggering, with billions of dollars being funneled into the war effort. Direct military spending is substantial. The costs of maintaining troops, equipment, and logistics are immense. Every day, the expenses continue to mount, draining the national treasury. It consumes a significant portion of the national budget. Funds that could have been used for social services, healthcare, and education are being diverted to sustain the war. But the true cost of war extends far beyond military expenditure. The economic repercussions are felt across various sectors, leading to a ripple effect that impacts the entire economy. It includes the hidden costs borne by the banking sector. Banks are under immense pressure, facing liquidity issues and a loss of public confidence. These costs are not immediately apparent in official figures. They are often masked by complex financial maneuvers and accounting tricks. They are buried in the balance sheets of Russia's banks. The true extent of the financial strain is hidden from public view, creating a false sense of stability. The Kremlin has forced banks to finance the war effort. This has led to a significant increase in non-performing loans and financial instability. These are not loans given freely. Banks are coerced into providing funds, often against their better judgment. They are effectively a hidden tax on the banking system. This hidden tax erodes the financial health of banks, making them more vulnerable to economic shocks. This has forced banks to take on enormous risk. The financial sector is now teetering on the edge, with the potential for a full-blown crisis looming. They are lending to businesses tied to the war effort. These businesses are often poorly managed and lack the financial stability needed to repay loans. These businesses are often unprofitable and highly vulnerable to sanctions. International sanctions have crippled their operations, making it nearly impossible for them to generate revenue. This is a recipe for disaster. The combination of high-risk loans, economic sanctions, and a strained banking sector could lead to a catastrophic financial collapse. The real cost of war is not just measured in lives lost or territories gained, but in the economic ruin that follows. After the invasion of Ukraine, a new law was enacted. This law mandated that banks provide loans to businesses deemed essential to the war effort. These loans were granted on preferential terms. Interest rates were kept artificially low. Repayment schedules were flexible. In essence, these were forced loans. Banks had little choice but to comply. The scale of these forced loans is staggering. Estimates suggest they total hundreds of billions of dollars. This is money that banks cannot lend to productive sectors of the economy. It is money that is effectively lost, propping up an unsustainable war effort. These loans are unlikely to be repaid. They represent a ticking time bomb for the Russian banking system. The strain on the Russian economy is evident in soaring inflation. Officially, inflation remains in the single digits. However, independent estimates paint a far bleaker picture. The real inflation rate is likely far higher. This discrepancy is a result of manipulated data and price controls. The Kremlin is desperate to maintain a semblance of stability. Forced loans and high military spending are fueling inflation. They increase the money supply without a corresponding increase in goods and services. This leads to a classic case of too much money chasing too few goods. The result is a rapid decline in purchasing power. Ordinary Russians are feeling the pinch as prices for basic necessities skyrocket. Section 5. Trapped in stagflation. The Russian economy is caught in a vicious cycle. The streets of Russian cities tell a story of economic hardship, with closed shops and empty storefronts becoming a common sight. People walk by with worried expressions, uncertain about what the future holds. The war in Ukraine has created a situation of stagflation. This conflict has not only caused immense human suffering but has also severely disrupted economic stability. The ongoing war effort drains resources and diverts attention from domestic economic issues. This is a toxic combination of economic stagnation and high inflation. The Russian GDP growth has come to a standstill while inflation rates continue to soar. Financial analysts are left scratching their heads trying to make sense of the dire economic indicators. It is a difficult problem to solve. Economists and policymakers are grappling with the challenge of finding a solution that can address both stagnation and inflation simultaneously. The stress is palpable in boardrooms and offices across the country. Addressing inflation requires raising interest rates and tightening monetary policy. The central bank is under pressure to act, but every move is fraught with risk. Higher interest rates could help curb inflation, but they also make borrowing more expensive, which can stifle economic growth. However, this risks exacerbating the economic slowdown. The stock market reacts negatively to higher interest rates, and businesses find it harder to invest and expand. The economy slows down even further, creating a vicious cycle that is hard to break. The Kremlin is trapped between a rock and a hard place. Political leaders are under immense pressure to find a way out of this economic quagmire. The choices they face are stark and fraught with potential pitfalls. Stimulating the economy to boost growth could further fuel inflation. While stimulus packages and increased government spending might provide short-term relief, they risk driving inflation even higher, making everyday goods and services more expensive for ordinary Russians. Raising interest rates to combat inflation could deepen the recession. Higher interest rates can cool down inflation, but they also slow down economic activity, leading to higher unemployment and lower consumer spending. There are no easy answers. The complexity of the situation leaves economists and policymakers in a bind. Every potential solution seems to come with its own set of problems, making it difficult to chart a clear path forward. The underlying problem is the unsustainable cost of the war in Ukraine. The financial burden of the conflict is immense, draining resources that could otherwise be used to stabilize the economy. Military expenditures continue to rise, putting additional strain on an already fragile economic system. Until this is addressed, the Russian economy will continue to suffer. The path to recovery is uncertain and fraught with challenges. Without a resolution to the conflict and a comprehensive economic strategy, the cycle of stagflation is likely to persist, leaving the Russian people to bear the brunt of the economic pain. Section 6. The Specter of Collapse. The Russian banking system is teetering on the brink of collapse. The forced loans have weakened bank balance sheets. They are saddled with debts that are unlikely to be repaid. This has eroded their capital buffers and increased their vulnerability to shocks. A full-blown banking crisis is a very real possibility. There are several potential triggers for a banking crisis. Accelerating inflation could erode public confidence in the ruble. This could lead to bank runs as people rush to withdraw their savings. Alternatively, a major default by a company that received forced loans could trigger a domino effect. This could lead to a cascade of bank failures. Section 7. Fallout from the abyss. The consequences of a banking collapse in Russia would be severe. Domestically, it would be devastating. Ordinary Russians would lose their savings. Businesses would collapse. Unemployment would skyrocket. Social unrest would be widespread. The Kremlin's grip on power could be jeopardized. The impact would also be felt internationally. A Russian banking collapse would send shockwaves through the global financial system. It would disrupt trade and investment flows. It would likely trigger a new wave of sanctions against Russia. The geopolitical fallout would be significant, exacerbating existing tensions. Section 8. A fragile grip on power. Putin's hold on power is not as secure as it appears. He relies on a social contract with the Russian people. This contract promises economic stability and a certain standard of living in exchange for political acquiescence. A banking crisis would shatter this fragile contract. The economic fallout from a banking collapse would be deeply unpopular. It would expose the true cost of Putin's war in Ukraine. It would erode public support for his regime. This could embolden opposition groups and lead to widespread protests. Putin's grip on power could be fatally weakened. Section 9. Ukraine's potential advantage. The looming banking crisis in Russia could have implications for the war in Ukraine. It weakens Putin's hand. He is acutely aware of the economic fragility of his regime. This could make him more amenable to a negotiated settlement. Ukraine could leverage this to its advantage. Ukraine could demand significant concessions from Russia in exchange for any agreement that could help stabilize the Russian economy. This could include a complete withdrawal of Russian troops from Ukrainian territory. It could also include reparations for the damage caused by the war. The economic crisis gives Ukraine leverage in future peace talks.
So hit that subscribe button, ring the bell for notifications, and let's turn the page on a new adventure together. Get ready to experience books like never before, only on VBook 360. Like, comment, and share to support the channel and keep the video magic alive. Thank you for stopping by. And remember, every video has a story, and every story deserves to be shared. See you in the next video.